Every time you swipe your card, deposit a check, or pay your mortgage, you're operating inside a system designed by one man over a century ago. His name isn't taught in schools. His face isn't on currency. Most people live their entire lives without ever hearing who he was. But his design controls every dollar you'll ever touch, every transaction you make, every debt you carry, every cent you save. Paul Warburg. And here's what should terrify you. The system he created in 1913 wasn't designed to help you. It was designed to ensure you could never escape monetary control. Think about your last paycheck. It went into a bank account. That bank operates under rules Warburg wrote. The interest rate on your savings, if you even get one, that's controlled by institutions Warburg designed. Your mortgage payment, your credit card rate, the reason your grocery bill keeps climbing while your paycheck doesn't. All of it traces back to mechanisms this man engineered. You think money, but the money is managing you. You work, you earn, you save. And the system automatically transfers your wealth away through inflation you didn't vote for, through interest rates you can't control, through a debt-based currency structure you never agreed to. Not by accident, by design. Here's what people don't understand. Before Warburg, America had financial chaos. After Warburg, America had financial control. And that control wasn't designed to serve you. This is the story of how one man re-engineered American finance and why you've been living inside his machine ever since. But before we understand his design, you need to know what America looked like before Paul Warburg arrived. You need to see what problem he claimed to solve. Because the solution he provided wasn't a solution at all. It was architecture. And you're still trapped inside it. Late 1800s America. Imagine a country where banks failed the way crops failed, suddenly and without warning, where you could deposit money on Monday and find the doors chained shut by Friday, where the dollar you earned in New York might not be accepted in Chicago. This wasn't ancient history. This was America 50 years after the Civil War, the wealthiest nation on earth, and its banking system was chaos. The Panic of 1893. Over 600 banks collapsed. 15,000 businesses vanished. Unemployment hit 20% in some cities. People lined up outside failed banks holding worthless deposit slips, their life savings gone. Not because they made bad decisions, but because there was no system to prevent collapse. No central authority, no coordination, just regional banks issuing their own notes, operating on their own reserves, failing on their own schedules. Then came 1907. The panic that changed everything. October, the stock market fell 50% in 3 weeks. Banks across New York faced runs. Depositors demanding cash the banks didn't have. The entire American financial system was hours from complete collapse. And you know who stopped it? Not the government. One man, J.P. Morgan, a private banker who locked other bankers in his library until they agreed to pool resources and stop the bleeding. One individual with enough wealth and connections to personally bail out the United States economy. Think about that. The richest country in the world, rescued by one private citizen. The public was furious, terrified. How could one man have that much power? How could the entire system depend on whether J.P. Morgan decided to make some phone calls? America needed a solution. Congress demanded reform. The public wanted protection from banker control. What they got was something else entirely. Because the man who would create that solution was already on his way from Germany, carrying blueprints for a system that would make the 1907 panic look like practice. A system that wouldn't eliminate banker control, it would perfect it. Enter Paul Warburg, not a politician, not an economist, a banker. And he had studied something America hadn't: how to control money without appearing to control it. Paul Moritz Warburg, born Hamburg, Germany, 1868. Not just any banking family. The Warburg banking dynasty, M.M. Warburg & Co., established 1798. 7 decades before Paul was born, his family was already moving money between European capitals, financing trade routes, underwriting government debt. The Warburgs didn't just participate in European banking. They helped architect it, connections to the Rothschilds, to the great financial houses that coordinated central banking across borders. Paul grew up inside this machine. While American bankers were fighting over regional territories, Warburg was studying something far more sophisticated: how the Reichsbank operated in Germany, how the Bank of England coordinated with Parliament, how central banks didn't fight private banks, they partnered with them, how you could control an entire nation's currency not through government force, but through institutional structure. 1895, he married Nina Loeb. Not a love story, an alliance. Nina's father was Solomon Loeb, co-founder of Kuhn, Loeb & Co., one of the most powerful investment banks in America. The marriage connected German banking expertise with American banking access. And in 1902, Paul Warburg arrived in New York with something American financiers didn't have: a blueprint. He spent 5 years watching, learning how American banks operated, studying the chaos. And in 1907, when Morgan had to rescue the system, Warburg saw his opening. He started writing essays in banking journals, speeches to financial associations. His argument was surgical. America needs a central bank, but you cannot call it that. Americans still remembered the first Bank of the United States, shut down in 1811. The second bank, destroyed by Andrew Jackson in 1836. The phrase central bank meant government control or foreign manipulation. It meant the end of your political career if you supported it. So Warburg proposed something linguistically brilliant. Don't call it a central bank. Call it a Federal Reserve System. Federal implying government oversight, public accountability, democratic control. Reserve suggesting safety, a backup, stored wealth protecting depositors. Neither was true, but the names would work. Warburg understood what American politicians didn't. You don't seize control of money. You engineer a system where control is built into the structure, where the design itself makes alternatives impossible. Then came November 1910, Jekyll Island, Georgia, a private resort owned by some of the wealthiest families in America. Senator Nelson Aldrich, chairman of the National Monetary Commission, sent invitations. Not official invitations, quiet ones. Paul Warburg received his. So did Frank Vanderlip, president of National City Bank. Henry Davison, senior partner at J.P. Morgan and Co. Benjamin Strong, vice president of bankers. Trust. A. Piot Andrew, assistant secretary of the Treasury. 6 men controlling a quarter of the world's wealth, traveling separately to avoid attention, using code names to avoid reporters. Aldrich was known as Senator. Warburg as Mr. Smith. For 9 days they worked. No minutes recorded, no journalists allowed, just 6 men drafting legislation that would govern every financial transaction in America for the next century. They weren't writing a law, they were writing architecture, and America never saw it coming. What they created on Jekyll Island wasn't a bank. It was a mechanism. Let me show you how the design works and why you can't escape it. 7 mechanisms, 7 layers of control built into the Federal Reserve System. Each one designed on Jekyll Island, refined over 9 days, implemented in 1913. And every single one still operating today, controlling every dollar you touch. Let me walk you through the machine. Mechanism number 1, private ownership disguised as public institution. Here's what they don't teach you. The Federal Reserve isn't federal. It's a private corporation. 12 regional banks, each one owned not by the government, but by member banks. Private institutions holding stock in what sounds like a public entity. When the Fed makes profit, and it does, billions annually, that profit goes to shareholders first. Private banks. Then whatever's left over goes to the Treasury. You think the Fed works for you. It works for its shareholders. And here's why you can't escape it. Every bank that wants to operate in America must join the system, must become a member, must buy stock. There is no alternative banking structure. Warburg designed it that way. Participation isn't optional. Mechanism number 2, monopoly on currency creation. Before 1913, different banks issued different notes. After the Federal Reserve Act, One entity gained exclusive right to issue American currency. Every dollar in your wallet, look at it. It says Federal Reserve Note at the top. Not United States Note, not Treasury Note, Federal Reserve Note. That's not a technical term, it's a legal one. Those dollars are notes, meaning promises to pay, issued by a private banking system. You work 40 hours, your employer pays you in Federal Reserve notes. Not because they chose to, because they have to. Legal tender laws, written into the same 1913 Act, require you to accept Fed currency for all debts, public and private. You cannot legally refuse it. You cannot legally create alternative currency for interstate commerce. Warburg gave the Fed a monopoly, then made participation mandatory by law. And here's why you can't escape it. Try paying your taxes in gold. Try paying your mortgage in Bitcoin. Try writing your employees' checks in anything other than dollars. The system doesn't allow it. Mechanism number 3, fractional reserve banking. This is where it gets mechanical. When you deposit $1,000, you think the bank keeps your $1,000. It doesn't. Under fractional reserve rules, banks only keep a fraction, traditionally 10%. Now, as of 2020, 0% required. The bank takes your deposit and lends it to someone else. That person deposits the loan in their account, and the bank lends that again. Your original $1,000 becomes $10,000 in the money supply through multiplication. The bank isn't lending someone's savings. It's creating money through the act of lending. Money that didn't exist until someone signed a loan contract. And here's why you can't escape it. Every bank account in America operates this way. Checking accounts, savings accounts, business accounts, all of them part of the same multiplication system. There is no bank offering full reserve storage. The structure doesn't permit it. Mechanism number 4, debt-based money supply. Here's the part that should keep you awake at night. All money in circulation enters the economy as debt. The Federal Reserve doesn't print money and hand it out. It buys government bonds, which are instruments of debt, with money it creates electronically. The government gets money to spend. The Fed gets bonds paying interest. More money in the system means more debt in the system, because the money supply and the debt supply are the same thing, which creates a mathematical impossibility. You cannot pay off all debt, ever, because doing so would eliminate all money. The system requires permanent, growing debt to function. And here's why you can't escape it. To have money in circulation, someone, somewhere must be in debt. Your savings exist because someone else borrowed. The dollars in your pocket exist because the government borrowed. Warburg designed a system where debt isn't a problem to solve. It's the foundation. Mechanism number 5, inflation as invisible tax. The Fed controls how much money exists. More money created, same amount of goods, prices rise. That's not accidental, that's policy. Inflation transfers purchasing power from everyone holding currency to whoever receives the new money first. Banks, government, large institutions. Your savings lose value automatically every year by design. Since 1913, the dollar has lost 96% of its purchasing power. A dollar today buys what 4 cents bought in 1913. That's not failure, that's function. And here's why you can't escape it. You're paid in dollars, taxed in dollars. Your savings, retirement, checking account, all denominated in dollars, all automatically devaluing. You can't negotiate your salary in inflation-adjusted terms. You can't force your bank to pay interest above inflation. The structure doesn't allow it. Mechanism number 6, interest rate control. Every major financial decision you make, buying a home, starting a business, carrying credit card debt, depends on interest rates. And interest rates aren't set by free market supply and demand. They're set by the Federal Reserve through the federal funds rate, the cost of borrowing for banks, which determines the cost of borrowing for everyone else. The Fed raises rates, your mortgage payment becomes unaffordable. The Fed lowers rates, your savings earn nothing. Whether you can afford your house payment isn't determined by how much houses cost. It's determined by Fed policy. And here's why you can't escape it. All rates in the economy flow from Fed decisions. Mortgage rates, credit card rates, business loan rates, savings account rates. There is no parallel market offering rates independent of Fed policy. You either participate at their rates or you don't participate. Mechanism number 7, banking system dependency. Try this experiment. Try living for 1 month without touching the banking system. No bank account, no debit card, no credit card, no electronic payments. Your employer deposits your paycheck electronically. That requires a bank account. Your landlord requires rent payment by check or transfer. That requires a bank account. Government benefits, Social Security, tax refunds, all distributed through banks or prepaid cards connected to banks. Large cash transactions over $10,000 get reported to the Treasury. Structuring cash to avoid reporting limits is a federal crime. Businesses can legally refuse cash over certain amounts. And here's why you can't escape it. Economic participation in America requires banking system participation. Warburg didn't just design a better banking system. He designed the only banking system. 7 mechanisms, 7 layers of control. Every single one built by Warburg and his Jekyll Island colleagues between November 10th and November 22nd, 1910. This wasn't accidental, this wasn't improvised, this was architectural. And here's what should keep you awake at night. It was implemented perfectly. The sales campaign began quietly. Aldrich returned from Jekyll Island with a proposal, the Aldrich Plan, named after himself, presented to Congress in 1912. It failed immediately. Too obvious. A bill written by bankers named after a senator who represented banker interests, asking for centralized control of currency. The public saw right through it. They wanted protection from banker power, not institutionalization of it. So Warburg went back to work, not rewriting the substance, rebranding the presentation. Enter Carter Glass, representative from Virginia, chairman of the House Committee on Banking and Currency. A Democrat, a Southerner, a man who'd spent years criticizing concentrated financial power, the perfect front. Warburg worked behind closed doors, feeding Glass technical language, structural diagrams, the same Jekyll Island blueprint with different packaging. Glass presented it as his own creation, called it the Federal Reserve Act. Not the Aldrich Plan, not the Banker Plan. The Federal Reserve Act protecting farmers and small businesses from Wall Street control. Warburg testified before Congress as an expert witness, pretending to evaluate a plan he'd actually written. The performance was surgical. December 23, 1913. 2 days before Christmas. Most congressmen had already left Washington for holiday recess. The Senate voted 43 to 25. The House passed it earlier. President Woodrow Wilson, who'd received significant campaign support from banking interests, signed the Federal Reserve Act into law at 6:02 p.m. Warburg had his system, and America had no idea what it had just approved. Warburg was appointed to the first Federal Reserve Board in 1914, serving until 1918, overseeing implementation personally. Within 1 year, the system faced its first test, World War I. The Fed coordinated war bond sales, expanded money supply to finance military production, controlled interest rates to manage war debt. Inflation surged 18% in 1917 alone. The system worked exactly as designed. It didn't prevent financial crisis. It managed financial crisis in ways that served institutional interests. 1933, 20 years after creation, Executive Order 6102. Gold confiscation. Americans forced to surrender gold coins, gold bullion, gold certificates to the Federal Reserve in exchange for paper notes. Ownership of monetary gold became illegal for citizens. The Fed consolidated control over the one asset that competed with paper currency. 1971, 58 years after creation, Nixon closed the gold window, ended dollar convertibility to gold entirely. The dollar became pure fiat currency, backed by nothing except Fed policy and legal tender laws. Every constraint on money creation removed. 2008, 95 years after creation, financial crisis. The Fed created $700 billion in emergency lending, expanded to $4.5 trillion through quantitative easing, bought mortgage-backed securities, corporate bonds, assets no central bank had ever purchased before. Too big to fail became official. Doctrine. The system didn't just survive crisis, it used crisis to expand authority. 2020, 107 years after creation, COVID response. The Fed created $5 trillion in 18 months, unlimited quantitative easing, corporate bond purchases, municipal debt purchases. The balance sheet exploded to $9 trillion. Each crisis expands power. Each emergency becomes permanent policy. Paul Warburg died January 24, 1932, 18 years after his system launched. His design is more powerful than ever. So here's the question. Can you escape it? Your paycheck arrives Friday. Direct deposit into your checking account, processed through a Federal Reserve member bank, denominated in Federal Reserve notes. You didn't choose that bank because you loved their service. You chose it because your employer requires direct deposit, and every bank offering direct deposit operates under the same system Warburg designed. Your money sits there losing value. 3% inflation this year, 4% last year, 7% the year before. The Fed calls this stable. Your savings account pays 0.5% interest if you're lucky. The difference between inflation and interest, that's the invisible tax. Not collected by the IRS, collected by monetary policy. You can't negotiate out of it. You can't opt out of your paycheck. You can't demand payment in inflation-protected currency. The structure doesn't allow it. Your mortgage 30-year fixed rate sounds stable until you realize the rate itself was determined by Fed policy the month you applied. They raised rates, your payment went up $300. You didn't get a vote. You didn't receive notice. The Federal Open Market Committee met, 12 people you've never heard of decided monetary policy, and your housing cost changed. Your credit card rate, your car loan, your student debt, all flowing from the same source. The federal funds rate set 8 times per year by committee decision controlling the cost of every dollar you'll ever borrow. You try to escape. Some people buy gold, paying premiums to dealers, then capital gains taxes when they sell. The IRS treats gold as collectible property, taxed higher than stocks. Some people buy Bitcoin until they learn about Form 1099-B reporting requirements, FinCEN monitoring, proposed taxation on unrealized gains. Some people try using cash exclusively until they discover businesses can legally refuse it. Banks report deposits over $10,000, and structuring transactions to avoid reporting limits is a federal crime carrying 5 years prison. Every exit is monitored. Every alternative is regulated. Central bank digital currencies are coming, programmable money with expiration dates, spending restrictions, transaction monitoring built into the code itself. Warburg's design was for paper currency. The next version is digital and far more controlling. The Fed balance sheet never shrinks long term. Every crisis means more power. Every decade means more control. The pattern doesn't reverse. Paul Warburg has been dead 93 years. But every transaction you make today, every debt you carry, every dollar you save, it's all still happening inside the system he designed. You didn't choose to enter it. You were born into it. And that was the most brilliant part of his design. Understanding the system doesn't let you escape it, but it does let you see the cage. Subscribe to see how these systems actually work and who else designed the world you can't escape.